It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
Hey, it's Tyrone Jackson, the wealthy investor. Welcome to episode 192 of the Trading Stocks Made Easy podcast. Today, I'm going to be talking to you about the whole, cheap stock thing. A lot of people, when they start trading or investing in the stock market, they think, I want to get cheap stocks because my money will go further. What they don't realize is there's actually a cheap stock trap. And I'm going to tell you about it because generally stocks that are under $20 simply don't rise. And if they do, they don't rise for long. So let me give you a little bit of an overview here of how the stock market really works. And today I'm giving you inside secrets no one else is ever going to explain to you. So this is the basic premise of the stock market. What drives a stock price higher? Revenue or demand. And what does that mean by revenue? Well, imagine going on a date with someone who you really like. You're attracted to them, they're attracted to you, and their income is constantly rising. Now, if you're above 30 years old and you want to get serious with someone, the person you want to get serious with is someone who's earning more and more money as they get older, right? If you're over 30 years old and you start dating someone whose income is going down from $75,000 a year to $65,000 to $45,000 to $30,000 a year, what is that going to do for your relationship? Well, it's going to make it very hard for you to buy a house, a car, build a solid future with someone if their income is declining. Well, in the stock market, something similar goes on. When you go on a date and you buy a stock, you make an investment in that company. What are you actually investing in? You're investing in the stock price not only going higher, but what you're really investing in is the growth in revenue, the growth in income in the company that's publicly traded. You see, a lot of people say, I'm buying these shares and I have a feeling they're going higher. Let me tell you something. When you start investing $5,000, $10,000, $15,000, $20,000 in a stock, you don't want to rely on your feelings. You want to rely on fundamentals. That means if you're one of those persons that are buying shares, let's say in Amazon or Microsoft, based on a feeling, you're really not investing because you really didn't read the income which comes out on a quarterly basis with publicly traded companies. You are not familiar with what's going on inside the company. So if you're going to be what's known as a self-directed investor, then guess what? You have to learn how to invest your money well. Many of the popular names we see in today's society experience their share prices rising. Why? Because the revenue on a quarterly basis keeps rising. So don't be fooled by a company's name that you recognize and the stock price goes nowhere. That's just gambling. And what I am teaching you to do step by step is to do what? Learn how to be a better investor. So when revenues are rising on Wall Street, institutional investors are attracted to the stock the same way retail investors like you and I are, right? So the difference between an institutional investor and you and I is that instead of us buying 10, 15, 20 shares at a pop, they're buying 10 million shares at a pop, 20 million shares at a pop. And when they come in with all that buying power, guess what? That creates demand for the stock in the stock market. It literally pushes the price higher. Now, these institutional investors are really good at making sound decisions. And one of the decisions that they never make is to buy stocks below $20. Now, listen to today's show because it's really informative, and this should build or add to your confidence as both an investor and as a trader. If I knew or I could accurately pinpoint the stocks in which institutional investors are attracted to, well, then that's half the game. I just need to become acquainted with the stocks that they favor that causes on Wall Street something called positive sentiment. Positive sentiment is a good vibe about a stock, a good feeling, but not just a good emotional feeling, but it's based on the fundamentals. Okay? So stocks that are rising, that are above $100 a share, typically have strong institutional involvement in them, and that pushes the share price higher based on strong fundamentals. Do you get that? Cool. Let's go one step further. Not only do I like investing in stocks with their strong fundamentals, but if the company pays a dividend, that means they're sharing profits with the shareholders. Well, why don't we play this game for real? Instead of buying $12 stocks, find as many stocks that are over $100 a share with strong institutional involvement in them, and if they pay a dividend, voila! We're picking great stocks, or great dates, as I like to say in the Wealthy Investor Program. Now, I know for some of you listening right now, this is going to be a light bulb episode like, wow, Tyrone, this really isn't that hard if we just choose stocks that fit a certain profile that we know the institutions like, that pay a dividend. Over time, we should be fine. Yes, yes, and yes. That's why this show is called Trading Stocks Made Easy, not Trading Stocks Made Hard, because I've built my whole career on demystifying the stock market, meaning making it simple for you so you, your family, your kids can begin to get involved with the stock market and change your life. See, we're in the middle of a revolution right now because of technology. Never before in the history of the stock market have we had so many blogs, podcasts, and commentators on radio and television shows. You choose to listen to me. You choose to be faithful to me and the whole Wealthy Investor system, which I think is very smart. You know why? Because it actually works in up markets or down markets. Now, let's talk a little bit about when you're buying a stock at $6, $3, or $12, why there's a lower likelihood it will continue to move, because there's no institutional dollars behind it. It's just a bunch of retail investors buying and selling and buying and selling and buying and selling. And without that institutional investment, the stock may go from 12 to 22 and then back down, but there's no conviction. You see, when institutions invest in stocks, their first round may be 1.5 million shares. Then they wait for the next quarter. They wait to find out what's going on fundamentally, and then they buy more. Now, pay attention. It's their consistent buying pattern that's going to push your shares up sustainably over time. You may have a $12 stock that goes up to 20, back down to 11, then to 9, then back up to 20. That is typically not sustainable. It's just a bunch of people jumping in and out of stocks, causing the stock price to move, go down, so on and so forth. Now, here's what we know, because we saw this 2 years ago with meme stocks, that if you can spread enough news online and get people to think that the stock is going higher, while you're convincing the audience of hundreds of thousands, or even in some cases millions of people to buy the shares this Wednesday, when you send out that buy signal, do you know what the originator of that message is doing? They're selling. This is how you get caught in a cheap stock rally, because when someone says now is the time to buy, they are actually selling hundreds of thousands of shares as the stock price is rising, and they're waiting for what? For it to come down so they can buy it back and go, all the selling is done. We're going to tell you when it's time to buy. That is called manipulation. Now, without getting too technical, because I know some of you have yet to open an online trading account, you're not that familiar with stocks, but I will tell you, and this is for those of you who are a little bit more sophisticated, the float, meaning the amount of shares outstanding, is very small. That means it's easy to manipulate. So the people who are causing the stock to jump in and out and giving you directives on these cheaper stocks, they already have a plan to get you to buy in so they can sell into the rally and do it over and over and over and over again. Now, let's talk about luck here for a second in the market. Some of you go, well, I'm a great penny stock trader. No, you're not. You're just getting lucky. You're getting lucky off someone else sending a message to a message board, or through a website or blog, you got lucky and you started selling when all the activity began. That doesn't mean that you're good. Okay? You're good when you can choose stocks at, let's say, $100 and they go to $200, $300 consistently. If you could do that for 15 years, you're brilliant. Now, I'm here to tell you one thing. If you have an open mind, you're brilliant. Because that's what the Wealthy Investor System is all about, is instead of guessing, looking at fundamentals, following the institutions, that's where you're going to make sustainable money. That's where you're going to build wealth. That's where you're going to collect dividends. That's where you're going to master the game of stock market investing. Back in a moment.
Want to increase your stock market trading profits? Then you need to start your monthly membership to WITradeschool.com right now. Don't understand how to write covered calls for monthly income? No problem. Simply review Tyrone's latest stock trades in our video library as many times as you need. WITradeschool.com is all about helping you get the financial education you need to earn money in the stock market and change your financial life. Tyrone Jackson, the wealthy investor, has helped his students earn thousands of dollars per month trading stocks online from home. These are people just like you. So what are you waiting for? Follow Tyrone Jackson's red-hot stock trades and investment strategies today. Don't wait. Start your monthly membership at WITradeschool.com right now.
Well, welcome back. Today we're talking about that cheap stock thing, why you never want to do it. The game is bigger than you, and it's hard to be consistent when there's smaller players online pumping up the price of stocks, getting you to buy it, and then selling it off and keeping that trend going. So let me give you some general ideas. Stocks that are between $1 and $20, they're called penny stocks. Generally speaking, they trade not on a major exchange on something called the pink sheets. They're smaller. They have smaller staffs. Sometimes these companies only have 2 or 3 people actually working at them. And they've really made their money when they hit the open air and take that company public. Stocks that are in the $20 to $50 range usually have come down off of some high for some reason. Either they had to cut their dividend, the revenue slowed. They may still have institutional money in them, but these days, and this is specific to this market right now, a stock that drops from $50 to $20, something happened at that company. Now, I'm not here to bash companies whose stock prices have dropped from 50 down to 20, but I could tell you this, they're not the strongest companies fundamentally. Therefore, you want to watch out. Now, there are some people who go, hey, a stock has dropped from 20 to 50. I'll pick it up on the dip and ride it back up to 50. Well, there's nothing wrong with that. That's actually a legitimate way of trading a stock. However, you have to know fundamentally what's going on at the company. Stocks that are in the $50 to $100 range, this is where it gets interesting. The institutions may have pulled out, but there could be something short-term going on at the company to cause that dip, to cause the banks, the credit unions, the college endowments to say, hey, we're going to take some profits here and see how this company does fundamentally over the next 6 months. And if they can fix their problems, we will buy the shares back. In today's market, you're going to find more success owning shares above $100. Why? Let's put this all together. Think about this with me, because the stocks that are over $100 have stronger institutional commitment to them. Okay? So that means, in effect, that you and I are always agreeing with the institutions in the stocks that we select. It's not hard. You might not get as many shares, but you want to be on as many trains leaving the station as possible because there are good fundamentals at the company. So there is a difference between truly investing based on fundamentals and gambling based on stock price. You have to know the difference. And anybody who listens to this show on a regular basis knows that I am not a fan of cryptocurrency. Why? There's no fundamentals behind the currency. It's all sentiment. So when Wall Street wants to drive up the price of cryptocurrency, they can. When they want to sell it off, they can. Why? There's no basis underneath. Now, every time I do a show like this, I get a bunch of emails. Tyrone, you don't understand. I made a lot of money in cryptocurrencies. Yes, for now. Will you make a lot of money in cryptocurrencies 6 years from now? Probably not. I understand that things in the economic world constantly are changing. However, when you start to invest hundreds of thousands of dollars, the old boring system on fundamentals actually works. That's why Costco is trading over $500 a share, because the company is fundamentally sound and there's room to grow. And someday we're going to get a stock split. Why? Because fundamental growth is a systemic pattern that you can follow over and over and over and over again. Now, let me talk to you about this whole cheap stock thing and your millionaire mindset, because we haven't talked about the millionaire mindset for a little while. You see, people who are millionaires or self-made millionaires recognize patterns. Have you ever seen a Van Gogh painting go for, let's say, hypothetically, $56 million at an auction? Why is somebody willing to pay $56 million to buy a painting as an asset? Because that asset has proven to increase over time. What makes it more valuable? The desire for that painting in the marketplace. So, in real estate, they say buy low and sell high. In the stock market, we buy high to sell higher. We buy things that have already proven their value, that have a greater probability of increasing in value in the future. I apologize for the fact that you did not learn this in high school, grammar school, or even grad school, because the U.S. educational system is based on training worker bees, people who want to work for a living. And you're listening to a show about what? Wealth building. Two different objectives. If you're listening to my show on a weekly basis, you have some interest in having financial freedom. Good for you. So you need to learn to think a little bit differently and think in terms of residual income from the stock market and dividend collection, as opposed to trading time for dollars for the rest of your life. Because there's one thing we know, time for dollars will never get you financial freedom. But we do know everyone who is a billionaire is not flipping houses on the weekend here, gang. You think Bill Gates is actually painting houses and flipping them? No, he's a billionaire. Where does this money come from? The stock market. Do you think Elon Musk, who created Tesla, is flipping houses? No, success leaves clues. This guy has what? At least one phenomenal publicly traded company. So if we follow the trails of what millionaires and billionaires do, most of their money is in the stock market. It is a pattern that is reliable. It's reliable. It's reliable. So I've been getting a lot of emails lately from people saying, hey, Tyrone, I've sold one of my houses and I've taken that profit and put my money in the stock market. Well, great, because you have traded one residual income vehicle, buying the house and renting it out and keeping the excess money on a monthly basis from the rent, to buying the stock, selling covered calls, and keeping the residual income, which is just like the rent money from the house, with almost zero headache. Because instead of having to manage tenants, you just have to manage the volatility in the stock. But there's always money to be made in the what? Out of the money covered call. So if you really are interested in being successful in the stock market, you have to understand how it works, how it functions, and where the big players are. And simply, well, how do I say this? Do what they do. And I'll tell you this about this episode. Please listen to it more than once so you can absorb these concepts. But I tell you this all the time. You have the potential to create financial freedom in the stock market. You should be successful. You can be successful. And I'm the guy who's going to help you do it. Thank you so much for listening to episode 192. We don't want that cheap stock. We want the stocks with the greatest probability of going higher because it has what? Institutional involvement behind it. I'll see you next week.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button and you'll automatically receive our next episode.